Welcome to Top Forex Academy, a place where you get access to exclusive training, proven strategies, and experts mentorship that have helped countless of our students achieve financial freedom. Start your journey today and turn your ambitions into realities. You can check our services here. We have Forex trading courses that suit your purpose. We have live trading sessions, risk management workshops, and lots more. At Top Forex Academy, you can unlock the secrets to successful trading. We can help you master Forex trading with our expert guidance. Our Forex Trading Academy is your journey to mastering the art of Forex currency trading. Our expert instructors provide comprehensive courses and personalized coaching to help you unlock secrets to successful trading. Whether you're a complete beginner or an experienced trader looking to refine your skills, at Top Forex Academy, we offer cutting-edge resources and personalized supports to elevate your trading game. Learn to navigate the Forex market with confidence and precision, backed by in-depth knowledge and proven strategies. Join our community of passionate traders and embark on a transformative journey to mastering Forex trading. At our academy, we have a list of programs that suit your purpose. All you need to do is visit our website and you'll be able to have a list of programs or services that suit your purpose. We have Forex fundamentals, risk management training, technical analysis workshop, live trading webinars, one-on-one mentorship programs with Forex Signal subscriptions, and also VVIP premiums for those that are looking to upscale their learning in the VIP section. We are currently having an empowerment series at our academy, and we encourage everyone to participate and to tap into the wealth of experience of our seasoned instructors. Welcome to Forex Basic Class Series 1 at Top Forex Academy. Our website again is bit.ly Top Forex. This series is powered by FOREXVPN. Today, we're going to have in Module 2, Understanding the Basics of Forex. Let's dive in. In this lesson, we will cover the basics of Forex trading, including currency pairs, trading hours, market structure, and liquidity. First, let's talk about currency pairs. A currency pair is a combination of currencies that are traded in a Forex market. For example, the EUR/USD currency pair, commonly known as FIBOR, represents the euro and the US dollar. When you buy a currency pair, you are buying the base currency and selling the quotes. So let me show you what the base is in this currency pair. We have euro and USD. The euro here is the base currency, while the USD is the quotes. All right, let's discuss trading hours and sections. The Forex market operates 24 hours a day, 5 days a week, with trading sections in different time zones. The first zone we'll be looking at is Sydney. In the UK time zone, is traded from 10 p.m. to 7 a.m. The Asian is traded from 1 a.m. to 10 a.m. The London session is traded from 8 a.m. to 5 p.m., while the New York session is traded from 2 p.m. to 11 p.m. Though these markets are traded 24 hours a day, notwithstanding, a successful trader need not be in the market the whole hours of the day. That is why we need you to understand the best time for you to trade. In this class, we are recommending the dynamic time for sufficient liquidity, which is between 8 a.m. and 3 p.m. That is the best time for you to trade the Forex market. Now let's see the 4 major windows in the Forex market. We have the Asia range, pre-London, the London window, we have the pre-New York, and we have the New York window. You can see from the Asia range, you have the markets coming slowly. There are not enough people in the markets, and so the market is not pulling too much liquidity. Now we have the London window intercepting with the New York window. So you want to trade from the beginning of the London window, and you want to end your trade before the end of the New York window. That is 3 p.m. or 15 hours. So we calculate the dynamic time for sufficient liquidity for every trader learning to be better at what it does is to trade between 8 a.m. and 3 p.m. Now let's see about 13 currency pairs and their common names. This is essential for discussion in any place you find yourself. You want to call their common name rather than calling the currency pair for security and other reasons. Here, GBP USD, which is the British pound / US dollars, is called cable. Euro / American US dollars, fiber. Euro JPY, UP. Here, USD Switzerland's francs, Swizzy. American dollar / USD, Aussie. USD card, Loonie. Then we have Kiwi, Noki, Stocky, Churning, Gopher, Ninja. And last but not the least, we have the Euro / BTC known as Nakamoto. Now let's look at the currency pairs and their correlations. Now this is important because sometimes when you are trading some currency, e.g. Euro USD, you will notice that it is moving almost the same direction with GBP USD. This is because they have a very high correlation of almost 90%. All right. So the same goes for other currency listed here. We want to look at the USD card versus oil. Now, whenever the Canadian economy is booming, you see the USD card booming against the dollar, and then you are meant to do what? To sell this currency pair. Because this is the base currency and this is the quotes. When you are selling this currency pair, the oil is booming because you can see that it is in minus 93% correlation with this pair. So the oil is a function of, the Canadian economy is a function of the oil price. Now, let's look at elements of market structure. The market structure consists of phases and trends. It is important for you to note that the market will always distribute, accumulate, and then redistribute. All right. So this is a circle that keeps occurring. So proper study of the markets can reveal this behavior every time. The markets usually come in phases. And why does the market really do this? Because all financial markets works on the universal law of supply and demand. Let's look at the laws of demand, which states that the higher the price of an item, the less the demand. That is, buyers won't buy at a higher price. The lower the price, the higher the demand, because buyers want to buy at a low price. So it's also in Forex markets. You see that when the price is very, very low, buyers will come in and buy, pushing the price upward. And when the price is very, very high, Sellers will come in and sell because the price suits them and then pushing the price downward. The law of supply conversely says the higher the price of an item, the higher the supply. Sellers want to sell at a higher price. The lower the price, the lower the supply, because sellers don't want to supply at a lower price. So basically, the price goes up to find the seller and then goes down to find the buyer. Now let's check the characteristics of the market in various trends. We have the upward trend, otherwise known as the bull trend. We also have the downward trend, otherwise known as the bear trend. We also have the sideways. Now let's look at the bull trend categorically. We're starting from here. This is our low, and then we'll move to higher high. We're tracing back to higher low. Then you see an impulsive movement again to the upper side, giving you a higher high. A retracement back to higher low, another impulsive movement to another higher high. So when you see that the resultant movement is to the upward side, then you call it a bull trend or an upward trend. You can also notice a break of structure on this point. After it gets to this point, retracing down, it breaks structure to another higher high, come down, break structure again. These are characteristics of market structure. In the opposite direction, we have the bear trend starting from a high and then an impulsive movement to the lower low, reverse a little, break structure again with an impulsive movement to another lower low, and then reverse a little again, and then continues like that. When this market is not doing a bear trend or a bull trend, then is in a range which is more or less sideways. So in a sideways trend, you see equal highs and equal lows occurring in the markets. You don't have what we call higher high, higher low, or lower low and lower highs. Let's see a typical example on a chart and determine what trend it could be. Like here now, we have the starting point here, a low, and then moving up to a higher high, retracing to this point, a higher low, and you see an impulsive movement. And you see an impulsive movement from here to another higher high, breaking the structure of this place to another higher high, another retracement, higher low, breaking another structure again upward. So this is certainly what? A bull trend or an upward trend. Okay, so for you to gain from this kind of structure, you need to know when to come in. Like here now, the buyer is trying to come in from here. You could also come in from here, and here. In the advanced class, we will be showing you how to come in. On our other videos where we treat fundamental analysis and technical analysis, we'll be looking at this at a more detail. And then in other advanced class, we will be giving you tricks on how to determine your entry points. But for now, in the beginners class, we just want you to understand the market structure, identify it, and be able to draw the market movement and understand the story the market is saying. Let's say another example in the live charts. You can see that Euro-US dollar is showing us a trend. What trend is this? Now let's determine it. This is a point and a high. This is another point, a low. This is another point, another high. But you can see that this is like an equal high, so we will not use this. So we can see this high, all right? After this high, we have a low. We call it a lower low. Then a retracement, a lower high. Then you see a break of structure beyond this point, downward to form a new lower low. And then a lower high, another lower low, another low. You can see a retracement back to a lower high, another lower low, just like that, and continue just like that. So this is obviously what? A downward trend, or you call it a bear trend. You can identify it by ruling out those points where you have your retracements. This is another example. I want you to pay attention to the fact that there are lines drawn across the charts. This line is the first resistance. This line is another resistance, resistance 2. But you see this chart is moving upward, breaking this resistance and turning it into a support. You can see here, turning to a support and moves upward, okay, and then touches this second resistance, bounces back here, make this a support, breaks the resistance and go up. So when this kind of break of structure to the upper side is happening due to impulsive movement like this, and like this, okay, you call it an upward trend or a bull trend. Let us see the phases in this market structure. You can see here we have the impulsive phase, and from here to here we have the corrective phase. So from wave 1, we have wave 1, impulsive, then we have wave 2, a kind of retracement, then wave 3, another impulsive to the upward trend, retracement, impulsive. So this is showing you how the phases are what? Occurring, how the market is moving to the bull trend with an impulsive action. Here we have a correction from wave 5 to wave A, and then a small retracement. Then you see another correction to wave C. Price moves in a structure of support and resistance. Also, we term it supply and demand in other cases. A break of structural support or resistance will lead to price movement in the next area of support or resistance. Just like we have here, you can see that this place is our resistance and here is our support. But the market is testing this place first time, come down, test it second time, come down, and then as it's testing the resistance about twice, it has tested the support about 3 times, 1, 2, and 3, and then breaks afterwards, breaks the support to the downward side, turning this support into a resistance. And the market continues the story. The same analogy is seen here. So we can see that a break of structural support or resistance will lead to a price movement in the next area of resistance or support. We want to look at what happens here. We have a support on the bottom here. A support is basically a place where price is being rejected to the upward side. When the market gets here, it's rejected to the upper side. Market gets here, it goes up. Market gets here, it goes up. So that's a support. But you can see now that when it gets to this support, it breaks through and go upward, breaking our resistance, and then break it to the next resistance, turn the former resistance to a support. Now we have this market going in this story, and then touches this resistance, tested it many times, breaks it again, turn the next resistance again to another support, and then go again, retested this new resistance, still breaks it again to the upper side, turning into a support. This kind of a thing is what is very common to the market, and it usually repeats itself. So that's why I would say the market is fractal in nature. It's important for you to always check the higher time frame to be able to understand these things. As a newbie taking the Forex basic class, you need to know how to do your analysis properly, top-down analysis, which involves starting from the higher time frame to the lower time frame, and then discovering your market structure, observing your break of structure, and knowing where the market is going. Like I said, in the next videos, we'll be showing you how to read the market structure properly, how to use technical analysis to understand it further, and to determine where you want to come in, to understand where you want to take your trade, to understand your entry points, your exit points, your stop loss, and your take profit. Now, let's talk about market structure and liquidity. The Forex market is a decentralized market, meaning it has no central exchange. Instead, transactions are conducted over the counter through electronic networks. Everybody come into the market and everybody goes out into the market. The sum of the profit and loss at the end of the trading day is zero. So although that's why we call it a zero-sum market. This makes the market highly liquid with high trading volume and tight spreads. Let's have some self-assessment questions to test our knowledge and to determine if we understand the basics of Forex. In the next lesson, we will delve into fundamental analysis and how it impacts Forex trading. We believe that after this fundamental analysis will come technical analysis, and then we believe that as a newbie, you are way ahead of any novice in this field, and you will be able to trade properly. You could scale yourself to intermediate trading level in the next 1 week. Just ensure you keep up with this trading. You can rewatch the video for more understanding. You can drop your comments in the comment section. We'll see reply them to help you scale. Also, the materials for this course will be uploaded in our community section. You could also check our website and register your email so you can get our newsletter, in which we'll be giving you some support for you to grow as you learn. Thank you for your attention. Kindly subscribe to the channel, Unilab Virtual. Sign up also on our link and get 50% sign up bonus as first time subscribers. Also, you can get $100,000 demo account for learning. You can also get 100% deposit bonus on your live trading account. Visit our website and follow us on our social media pages. Here are your self-assessment questions that you want to look up to gauge your knowledge. We look forward to seeing you again on this channel. Have a successful Forex trading.